we're going to have a series of lectures and workshops on TNC's financials. This is a really very short course of studies, and actually we're going to do that in only 2 lectures, in 2 lecture series, today and next week, and then we will separate into groups and come over to the workshops about these about the financials of the transnational corporations or just multinationals. So what are we going to study? What are we going to do in these courses? Like I said, we're going to have 2 lectures. Actually, this is not very much. This is not going to be a very long course. This course is very short. We have only 6 hours of lectures, and in these lectures we're going to cover mostly the basics about the transnational corporations' financial activities and their financial statements. We will talk about the development of their price share dynamics on the stock markets. We're going to learn a lot about their investments in other foreign countries. We're going to learn many things that come with the basic idea of what they do and how they do it. We're going to study one of the greatest and one of the most interesting topics in international economics, because actually business is always attracting much attention to new companies, to the companies from foreign countries, and we're very, very interested sometimes in getting to know better those companies. We're all eager to know something about the Tesla company, about Apple Corporation and what they do, and especially their financial activities across the globe, because that's what they are for. They create a lot of value-added activities across the globe. Transnational corporations is a powerhouse of the global economy. They produce almost everything. They produce everything starting with extractive industries. They produce oil and gas, and all the way to technologies and many other very, very interesting things in technology. They are the greatest internet companies. They are the greatest automobile manufacturers. They're the greatest social media companies like Facebook and Google. They are the greatest, the largest e-commerce companies and e-commerce empires from all the world, from the United States, from the European Union, from the UK, and many other countries. Of course, they are the basis of the global economy. They produce the overwhelming majority of goods and services in the world. They are very, very important in doing business in many emerging countries, because they are the basis of foreign investment there. They provide capital to those countries and to those nations. They create jobs, which is also very important in countries with high unemployment. They do each and every activity that we know of in the world of business, in the world of international trade, in the world of international technology exchange, in the world of technological change, in the world of exports of goods and services, in providing some sort of intellectual capital. They are the leading entities the leading business entities in exploring into artificial intelligence. They produce quantum computers, supercomputers. They produce chips. Actually, I cannot think about an industry where there would be no transnational corporations, and in each of those industries, in each of those market niches, they are going to be the leaders. They're going to be the greatest powerhouses, the largest industrial entities. In lecture 1, like I said, we're going to talk about the basics of the transnational corporations and their financial activities, about their financial statements, the profits of those companies, what they did and what they are doing today in terms of initial public offerings, in terms of providing asset management facilities to other nations and other companies. Transnational corporations include not only industrial companies, they include also very important service providers. Transnational corporations can be found in sectors such as insurance and financial services, financial advising activities, consultancy services, legal services. They provide people with lots of data. They encompass huge branches in the information industry, in the media, in the news industry, in the entertainment and other services industries. So then we're not only talking about, of course, industrial companies, but we're also talking about the services companies in the world and what they're doing in the global competitive markets, in the global competitive environment. I'd like to start with a very interesting point. Today, since the start, not today, but starting somewhere in March, somewhere in the spring of 2020, there was a sort of a market mania on the global financial markets, and many transnational companies gained a lot in terms of investor value. They went into the financial markets and they issued their bonds, they issued their securities and shares. One of companies such as these, the case study for us on this, which is shown on this slide, this is a GameStop company. GameStop, I think some of you could maybe know that this is a company that creates games for various groups of people for entertainment activities, and entertainment activities in lockdowns and social distancing measures were one of the largest and one of the greatest activities in the past 8 or 10 months. So almost a year ago since the start of the pandemics, and in the lockdowns people tended to spend more time at home, and one of the companies that gained from those lockdowns was GameStop. And if we look at the charts depicted here, we can see that companies such as this gained lots in terms of customer attention, in terms of lots of investor activities in the markets. In 2020, all the way to January 2021, GameStop shares remained absolutely flat. So they changed a little bit in value over the months, starting somewhere in November or in October 2020, but most of the time their share price remained really low, and it didn't exceed really much in those days. But like I said, starting from somewhere in mid spring 2020, they really faced a sort of a boom in their share value. And today this company is valued at more than $350. That was back on January the 27th. What you see here on the chart, this 3,000, 2,000, 1,000, that's not dollar terms. This is a percentage change in the share price of this company. Just in order to show how much this company increased and gained in corporate value and stock market value on the market. We also can compare the results of this really small company compared to the big tech average. The big tech, actually, this is a term used to understand and to explain, to include the companies such as Alphabet, Amazon, Apple, Facebook, and Microsoft. These companies, I think, they're not only one of the most interesting companies, international companies in the world, and most famous and most well-known companies in the world, but they are also very important in the stock market activities and in financial activities, because their market capitalizations are very, very large. And during some weeks and days of 2020 and 2021, their market capitalization exceeded well over $4 trillion US. This is a very great amount of money in terms of both economic activity and financial activity on the markets, and this tells a lot about these companies and their and the public interest for those companies. So today this company actually can be considered as a middleweight company with $24 billion in market capitalization. Compared to big tech daily trading volumes in terms of shares and millions of shares, we can see that first in November and December last year, 2020, big tech total exceeded actually the number of shares traded, the shares of GameStop shares. But in January and all the way to the end of January, the beginning of February, these daily trading volumes actually started getting closer and closer with the big tech total. That means that there are some companies in the stock markets that are very comparable in terms of financial interest and in terms of market mania for investors. Investor behavior really changed a lot during the past 12 months of 2020 and 2021. many people started investing more heavily into the international financial markets. They wanted to gain from that big boom in the financial markets, because, like we know, in March, when the pandemics began really accumulating and heavily pushing onto the global world economic powerhouses like the European Union and the United States, price shares first slumped, and then they started a very interesting and very spectacular climb up. And we witnessed really fantastic activities, both in terms of financial activities, in terms of international price negotiations, in terms of bond purchases, and other really interesting and very important things in the financial markets. And many companies gained a lot, and investors, especially after the central banks started decreasing in mass their interest rates, the key interest rates, the central bank interest rates, people started thinking about their savings, their life savings. In many countries, savings started just to be seen like something not very much interesting and not very useful. People started thinking about their life insurance policies, what they're going to do when they're retired, because if money turns no profit and interest rates are very low, so money is not going to produce any capital in the long term, people started looking for more interesting assets in the markets. And one of those assets was GameStop shares and other companies such as these. We can also give examples of Alphabet, Amazon, Apple, and Facebook, and Microsoft. They all really gained much in terms of market capitalization, and they were the most traded companies in the stock markets, and companies such as these. Also, what we can say about a platform that is used to keep these price shares going on, and we can talk about this also in terms of market capitalization. We can also say that we do have in the world, in the financial markets, forums such as our Wall Street Bets on the Reddit platform that have millions of followers, and these followers join some of the greatest activities in the markets, and they introduce their capital to those markets. They are a club of non-professional investors that are interested in non-traditional companies, and one of those non-traditional companies is GameStop. This spectacular increase in the market share attracted much attention on parts of the government of the United States, because really if that sort of mania, market mania, continues, we can be really expecting a sort of a boom in the market and a bust in the market after that. What is a success story behind the GameStop activities? Why is it so successful in terms of market value and in terms of dividend value for people trying to invest in this company? One of the explanations of that is that some people and some entities entering the markets used a sort of a strategy that allowed to buy the shares at very low prices and then resell them at higher prices. And they did that, and these investors are called usually short sellers. Their positions short. That's why they're short sellers. So they buy very cheap, and later they can also buy back those shares, and they ideally do that at lower prices. Also, one of the explanations for that success can be a bullish behavior in general on the markets during that particular time, because they were really interested in finding some new assets in the markets that would be very profitable. Also, when we're talking about investor behavior during these days, we are talking about the new generation of millennials. As we know, today across the globe, the overwhelming majority, the overwhelming volume, the largest share of the national wealth, of people's wealth in the world, belongs to people who were born after World War II. This is the so-called baby boomers generation. So this generation still keeps a very large share of wealth in the world. But this is going to change very soon, because the people who were born after World War II are going to be getting smaller in numbers, and due to demographic activity, due to demographic problems, due to just the aging processes across the Western world, and also because, well, the time has come for other people, for other generations to take part in this market mania. And the millennials, so the people who were born at the turn of the centuries, in late 1990s and early 2000s, these people are getting very strong in numbers, and they're going to be very different from their parents, from the previous generation. They're going to be more interested in greener stocks, in greener corporate activities. They're going to be concerned more about companies who are damaging the environment, who are contributing to climate change problems, and so they are not going to invest into companies that are really dangerous in these terms. They're not going to invest in ExxonMobil or Royal Dutch Shell. And one of the evidence that can be given for that sort of activity in this sort of period is that one of the largest oil company in the world, the largest oil multinational in the world, ExxonMobil, dropped out of Dow Jones Index. This company was included in Dow Jones Industrial Index in 1929, if I'm not mistaken, and ever since 1929, this company was at the top of the ranking of the Dow Jones Industrial Index. And now this company, after the dramatic slump in the oil prices in the spring of 2020, this company dropped out of the index, and it lost billions of dollars in terms of market capitalization, and this huge company was outpaced by intellectual companies such as Google, Microsoft, or Apple. This ExxonMobil Corporation, the largest oil company with activities and mines all across the globe, with refineries in many countries of the world, this huge corporation with lots of physical capital is worth actually much less than companies who deal only in services and provide internet access, provide cloud computing services, cloud computing programs, producing chips for quantum computers and supercomputers. So these the companies that were the basis of the global economy in the 20th century are going to leave the financial markets, and more companies, international companies from very high-tech industries, are going to enter, are going to replace those companies in all indices and all industrial activities and in all stock markets across the globe. One of the indices that show that is S&P 500 and NASDAQ index, and these indicators show that companies of the big tech, the companies from the green industry, environmental companies, they are going to be the leaders in the world that we're going to see in the 2020s and the 2030s. Everything is going to change, and change very, very dramatically. Also, talking about the current situation and the financial activities of the transnational corporations, what we can see is that one of the major indicators that shows why there are some slumps in the markets, why there are crises, depressions, and booms, and these sorts of things, we actually got to look at the CAPE ratio. The CAPE ratio is a cyclically adjusted price earnings ratio, a short CAPE ratio. This measure was developed by Robert Shiller of the Yale University, actually an economics Nobel Prize laureate. I think Robert Shiller also came to the financial university of ours and held a lecture during one of the international financial forums in the financial university a couple of years ago, maybe 5 years ago or so. So this person is very famous for his measure that he created to understand the dynamics of the financial activities on the markets. And this ratio is a very useful measure to understand these dynamics. Well, again, looking at the chart given here, we can see the dynamics in the United States of cyclically adjusted price earnings ratio of a number of major companies in the United States. We can see that this ratio rose really dramatically, increased really dramatically on 2 occasions, actually, in the past 100 years. And these occasions were, of course, the Great Depression, 1929, and the 2000s, the early 2000s, that were called dot-com boom. Dot-com boom, like you know, I think was a period when internet companies were very, very high-profile companies, and many people were crazy about investing into their shares, and the market activity also went crazy. There was a sort of a market mania back then, 20 years ago. And we also know that 2001 was the year of the greatest terrorist attacks on the United States, the September 11. That was a very so just like today, just like these days in the pandemics times, the pandemics was a trigger for a crisis that followed, and the terrorist attacks on the United States, the World Trade Center back in September 2001 was a trigger for the crisis that followed after these dot-com boom. So dot-com boom was followed by dot-com bust, and we've seen the same situation in almost the same situation in 1929. That was the year when the New York Stock Exchange crashed, and what followed was the Great Depression, the period of high unemployment, hyperinflation in European countries, in Germany, in Austria. That was the end of the British Empire and other great economic powerhouses in the world. After the Great Depression, the world witnessed the largest international conflict, the World War II. So, like today, people and some analysts at the World Bank and the International Monetary Fund, they think that after the crisis such as this, we're going to have something of the sort as well. A very great international conflict, a global conflict that may follow after that. In 2001, we had anti-terrorist alliance, so to speak, that was formed by the NATO countries, and the United States went to Iraq and Afghanistan. Then we also had the Arab Spring. So that was a period of great international conflicts. The difference from the Second World War, from World War II, was that back then, in the 1940s and 1930s, the world did not have atom bombs, nuclear bombs, and so I think that was one of the reasons behind the global military conflict of such a scale. Today, when most countries of the world have nuclear bombs, things changed, and wars cannot be a global or world conflict such as we had in the World War I, World War II, and things such as these. And also, one of the major examples of this CAPE measure growing too high was back in 1907. 1907 was the year of one of the greatest financial crises in the United States, when 500 banks collapsed, and this led to the creation of the Federal Reserve, the central bank of the United States, that started regulating the market. And it was really successful, and like we see, CAPE measure, CAPE ratio really decreased all the way down to some 6-7% ratio in 1920, but then it dramatically increased due to lax monetary policy on part of the Federal Reserve and deregulation activities. because the government embraced more liberal economic ideas about the markets, and that's why we've seen that great boom in the roaring 20s, the roaring 1920s, and the same sort of the roaring 2020s are coming for us as well these days. In 2021, we see that the escape measure, the escape ratio, is increasing really dramatically, and it also may mean that something is going to happen, perhaps. One other major factor, one other major thing behind the financial activities of the multinationals in the past 10 or 5 years was international problems with integration activities. Regional integration agreements experienced a sort of a crisis. We know that the world financial crisis of 2008-2010 brought with it lots of difficulties for the euro area. The European Union, like we know, is one of the greatest, and this is the largest, I think, the most integrated regional agreement. This is an economic and currency union, the monetary union. They share the same currency, they share the same markets in industrial goods, in services, many other activities. So they went as far as creating the European Central Bank to set interest rates, the key interest rate for companies and the banks to invest, to provide capital. Actually, the key interest rate of a central bank is very important in terms of economic activities for lots of companies and lots of organizations in the world. And that period was very, very important for the European integration. Like we know, the European integration was motivated by the transnational companies. He wanted larger markets, they wanted equal access to the markets across the European countries, because Europe is a bunch of very small countries and very small economies, like Portugal, Italy, Spain, so Greece, Holland, Netherlands, Denmark, and other countries. So they're very, very small. Austria, and the transnational corporations thought that, and managers, top executives behind them thought that integration activities are going to bring ever closer union and more profits. The monetary union was embraced by transnational corporations because it erased monetary borders. So you did not have to exchange one currency for another to export goods and services, and everything was and everything is now very simple from this point of view, because they are dealing in the single currency, which is the euro. But the world financial crisis brought very many problems to the integration activities in Europe, and many countries in Europe started accumulating huge debts. They are accumulating it still today in the pandemics. They accumulated hundreds of billions of dollars. In some of the countries, the debt to GDP ratio exceeded 100%. In France it exceeded 118%. In Greece it exceeded 230%. And Spain and many other countries, Italy 159% GDP debt to GDP ratio. So actually they're going to have very, very drastic changes in terms of regional economic integration and things such as these. The pandemics really the pandemics was just another factor, another accelerator in terms of economic problems in the European Union. The problems that were already involved and already attached to the European integration when it was created and when they accepted the euro. And after all this, in 2013, at the World Economic Forum in Davos, the then Prime Minister David Cameron of the UK said in a very powerful speech that Britain is going to leave the European Union if the European Union would not be more competitive. He outlaid 5 principles, and he said that these 5 principles are very important for the competitiveness of the European Union, and if the European Union does not keep to those rules, to those principles, Britain was going to leave. They held the Brexit negotiations, and now the Brexit is a reality. On January the 1st, actually 2021, Britain is no longer part of the European Union. What happened after that, and what started accumulating very dramatically in terms of the economy of the UK, is that many transnational companies who had headquarters in London started moving their headquarters over to the continent, to continental European countries, in Frankfurt, in Paris, and other major industrial cities and towns in Europe, in continental Europe. Britain, in terms of, and London specifically, because London and the city of London is the international financial center, one of the largest international financial centers. Actually, it's number 1 or number 2 in international financial center in the global financial industry. London and New York are the largest international financial centers, global financial centers. They process trillions of US dollars annually in terms of export operations, in terms of currency exchange, in terms of foreign exchange, of course, in terms of derivative trading, in terms of options trading, in terms of gold market speculations and other activities. They are very powerful financial industry in the city of London. And now that's going to change because transnational companies started moving their headquarters to Europe. They do not want this sort of border boundaries. They do not want these boundaries to damage their business activities, because bounds and boundaries, many other things, discriminatory policies usually damage business, usually damage corporate activities of many transnational companies, transnational firms. So they decided to leave. And in matter of days, in matter of weeks and months, the UK started losing, the city of London started losing huge amounts of money. Those transnational corporations started moving their capital, their investments to other European countries. You can see that since 2005, British firms' share of world market capitalization has fallen from over 7% down to 3%. And this is a very, very dramatic decrease. So they're going, there may be even more drastic changes in this situation, and very dramatic changes for the currency of Great Britain is going to come as well, and I think the UK is going to have more integration problems, more integrity problems in the future as well. If we speak about Northern Ireland and Scotland, he wished to hold referendums, independence referendums, and would like to leave the UK, the Union of the UK. So maybe this country is going to disintegrate just like just like Great Britain disintegrated, delinked from the European Union. So Scotland and Northern Ireland are also going to delink from the UK. And perhaps it's going to really be a very dramatic example, both in terms of the industrial capacity, both in terms of financial capacity of this economy. So let's continue. Let's speak about some of the very interesting activities in the e-commerce business. E-commerce is, I think, one of the major sectors and industrial activities in the global economy. I think this is a very strong and important point, both in terms of the capacities and major economic activities and relations in the in business environment and many other things as well. Dear students, do you have any questions for now?
No, we don't.
No, we don't. Dasha, are we going to have to switch to another class? Because I think we're going to do we need to finish this session and go over to another? Are we going to switch to another session, or can we leave it here and continue with the lecture in this session? Dasha.
I think we should switch.
We should switch, yeah?
Yes.
Okay, let's take a few minutes break then, and I would like to welcome you back again for another class. Thank you very much. I'm very excited to have you for another class of ours. Please rejoin.